Good day, all. Ira Epstein of Linn Associates with your agriculture update for this Tuesday, and this is the 25th of June, 2019, and we're getting on at 4:40 p.m. Central Daylight Time. As you can see, a down day in the wheat and the soybeans. Now, when we start looking at some of these chart pictures, you're getting your little bit of a correction setting in. Is it going to be more than that? I have my doubts, but it is a correction time. The market got yesterday the crop updated news in terms of the conditions, what was planted, and it wasn't enough to move the market. It certainly opened on a firmer note, but as you can see, 12 cents, actually 15 cents off the high of the day. So let's take a look at the chart and see what we've got. First, for the week, we're pretty flat. We're up about 3/4 of a cent, so not doing much there. You can see where we're getting some distribution in prices right here, and without a jolt to this market, I don't know what moves it all of a sudden from this level. We're like at a point in time where you know you're behind on the plantings. You're going to look each week to see how far the farmers got caught up, but you do realize by the end of this month, which is the end of this week, it's pretty much whatever the farmers have got in, that's what they've got in soybeans and corn. They can go longer, but the risks are phenomenal. So I'm looking to see what the market does here. Now, as we take a look at the market, you had an outside day down. And with that, you've created a pattern of lower highs, and because today's low is under a previous low, lower lows. So suddenly the trend is defined by the swing line is down unless you take out today's high. If you take out today's high, that negates this particular pattern. And that high would have to be taken out tomorrow or Thursday in order to do that. If you look at where the market might be headed, I don't see why not be looking at the 100-day average in the 18. They come into the range between 915 and 913 3/4. The resistance was seen on that first challenge of the upper Bollinger Band. You got through it here, kept coming back and then down to the 18-day average. I wouldn't be surprised that this pattern is another setup of this pattern and you try to get down to that number. There is support there. The bias is up in the market even though the trend is down. When I look at momentum, however, it has turned to the downside. Now, if we take a look at yesterday's, you were also overbought. So this is not a market that's coming out of a situation where it had embedded or locked in bullishness. It didn't do that. It got into overbought territory, and it's correcting. And the way you correct an overbought price is you either have it soar and you start an embedding process. I don't see that right here. Or you work sideways to lower and let the momentum come out, the upside momentum, get into non-overbought condition, which means both numbers have to have readings under 70. In the meal market, here too, you've got the pattern of lower highs, lower lows. If the market wants to break 312.80 to 312, the Bollinger Band to the 100-day average certainly looks like a support zone. Resistance is back at the 18-day average of closes. I would not want to see prices over today's high of 320.260. If it did that, you'd negate this bearish pattern. In the soy oil, you also turned in lower highs, lower lows, but you're over the 18-day average of closes. So the bias is up. What else? Momentum pointing down. So it's looking more and more like the bean complex wants to put on something of a small correction. Could be more than that, but that's what it's looking like right now. In the corn, you still have the position of higher lows but lower highs. See that? So I'm contending that the market is not trending. The market is drifting sideways. It has still got readings here of over a 70, so you've got to get that number under that tomorrow to no longer be in overbought territory. If the market falls, I would look for near-term support coming in around the 449 3/4 zone. That was an original resistance zone that we were looking at, and I know that way back we were telling farmers you get 450 in these corn, you might lock something up there. Seeing the market get through that right now, up where it did and pulling back 25 cents from it would not be a surprise. In the wheat market, the trend is still to the upside, but very overbought. Higher lows, higher highs. Support back at the 18-day average of closes, taking out yesterday's low in the market, which was 526 3/4, would be a sign that this market's way ahead of itself and wants to come down. Work your way down, don't do that, and this market's still going to look bullish. In the sugar market, not enough momentum to get down to the lower Bollinger Band just yet. And if it gets down there now, because you're in a territory here that is close to, it's not oversold. You need readings under 30 to be oversold, but getting close to it, that might get it into oversold territory. So what about the upside? Well, the resistance is the 18-day average in red. If you can clear this high, which specifically is 1276, you negate the downtrend and go flat again with resistance at 1287. In the coffee market, what a big run. So we had this correction that did not go back to a lower Bollinger Band. Yesterday we had an outside day up. If the market runs from there, the potential could be the upper Bollinger Band. Certainly looks to me like the market's trying to get up there in quick order, because you're already in overbought territory. You got a 70 reading. So do not be surprised if you get up there for the pros take some money off the table. In the cocoa market, the battleground is drawn. It's the 18-day average of closes. We've hit it a bunch of times. The pattern are lower high, lower low, but the settlement price is still what? Well, today it's underneath that 18-day average, and momentum's down. So on the close, the bears, in my opinion, grab control of the market. Their defense is probably going to be not let the market get over 25.33. I would not be surprised that they want to push under 24.46 to see what's under there in the way of people throwing in a towel or whatever if they're playing the long position. Take out that 25.33 and don't take that out, and you can flip around all of a sudden, have higher lows, higher high, and catch everybody on this trade and get up maybe to that upper Bollinger Band. So you've got some interesting areas here. In the cotton, the market is bearish. Lower highs, lower lows under the 18-day average. Now, what number do you think that the pros might want to protect? If you look at yesterday's high, it was 66.27. Today was 66.21. That's my guess. They don't want to get over that. If they do, what happens is you could change the chart picture to higher lows and a higher high right into that 18-day average. It's a real important day tomorrow. In the cattle market, finally getting a bounce off the lower Bollinger Band. We'll see if the market can get up to the 18-day average. Interesting that Canada today, one of the newspapers in Montreal made an announcement that the Chinese government is stopping, effective tomorrow, all meat imports from Canada. And the use is that there's no supervision on what Canada's doing. It's really about Huawei and the fact that they're still holding, if you will, that executive. And it's going to be an interesting G20 meeting. Now, Mr. Trudeau has a lot to talk about beside President Trump. Where's the beef coming from? If it's not the U.S. and not Canada, probably Brazil, Argentina. You got those areas. Lower highs, lower lows, resistance 104.32, but very oversold. I don't see the pros defending the 18-day average with bearishness because of how oversold you are there. And I have the same thing to say about the feeder. Now that you've gone to the Bollinger Band, where you're going to push the market. In the hog market, a bounce, but all you did is get back over that lower Bollinger Band. Remember, you'll trade within these bands 95% of the time. So when you step out of them, got to be careful how they step out and where they're stepping out from. After a prolonged decline, I think the market has a hard time staying under it. It's way easier to stay above it if you come out of sideways action, and then you can do that and you correct. But when you have a prolonged break, it's very hard. Let's talk about what we do here. You got a pig crop report coming up this Thursday. We're going to discuss that in detail. So if you're into the grain markets and into the meat markets, you see I'm already writing to you and talking, I put it in my newsletter, about what's going on with Canada, what that's going to mean. And of course, we all have to understand with the G20 coming up, if negotiators from the U.S. and China can get together, what does that mean? And I'm already writing a little bit about that tonight for my subscribers. So If you want to see what we write about, these are all the different subjects. You go to our website. It's free. We'll give you a trial to this. No credit cards, none of that ass fraud. And you get to see what we're telling our hedgers, what we're telling our end users, our speculators in futures and options. Now, if you're smart, you'll ask for a charting sample of our software because you get oral updates throughout the day, and if you miss them, you can go back and play them. And I think you'll find our expertise pretty strong in the commodity market. How do you get this? Either call us, go to our website. Front page, you'll see a carousel of free offers, or you can click right here. If you're watching me on YouTube, it'll take you there. I'm Ira Epstein. You have a great day, and I'll see you all tomorrow.